Netflix just reported after hours, and the stock is up a ton after hours. It's up over 6% as of right now. It's fluctuated all the way up to 7 or 8%. So what happened here? So they beat on their guidance. They had expected, there was guidance of $3 per share. They beat and got $3.20 per share in profit. Now, where do I get this information from? Guys, I don't care about the analyst expectations. I actually go right to the company and pull their exact press release on this. Now, a couple things. Revenue in Q2 grew 9% year over year, right? 9% year over year. It was 13% when you exclude a foreign exchange impact. Now, they did lose almost 1 million subscribers this quarter, but they're expecting to add 1 million subscribers next quarter. But one thing that's interesting here, look at their expectations for Q3 22. They're expected to have lower revenue than this quarter, and compared to Q3 of 21, though, it'll still be higher. Because if you look right here, their next line is year-over-year growth. It's still going to be 4.7% higher. So what's happened with Netflix lately? Guys, if you remember, this is a company that was sitting at $700 per share just 1 year ago, less than 1 year ago. They're now, after being up after hours a ton, they're at $213, $214, $215 a share. That's a 70% drop. So what does this mean? Well, if you're new to the channel, I'm Paul, and what I like to do is I like to look at stocks as buying a piece of a business. And if you overpay for potential, you're going to see a drop in price. And I think that's what happened with Netflix. Netflix, everybody thought, oh my gosh, COVID happened, everybody stayed home, the number of users shot up. Well, of course, I would sit there and say, okay, well, people had a reason to go all and try to join Netflix, but once they started going back to work, what's the real reason to add more and more people? And growth plummeted. In fact, they lost people. So, does that mean Netflix should be a zero stock? No. Remember, growth is an important aspect to investing, probably the most important. But you can't overpay for growth, and you can't underpay because they're stagnant companies, right? If I were to give you $1 a year the rest of your life, that's going flat for the rest of your life, but it's still worth something. In fact, if I give you $1 starting today and decrease it by 1 penny a year for the rest of your life, it's still worth something. It's even though it's a decreasing amount of money, it's still worth something, right? So that's what I'm trying to teach on this channel, the value approach, thinking independent of what expectations are. This is why I don't look at how they beat versus what they did, yada, yada, yada. What I care about is, can I pay a reasonable price for Netflix that even if they don't hit the major goals everybody talks about, that they can still do well? And that's my goal here. Now, in full disclosure, I have a lot of puts sold on Netflix at much lower prices than today. A put is where I'm selling somebody the option to force me to buy the stock at a much lower price. What's that price? Well lower than $210 or $215. Why is that? Well, I make conservative estimations on Netflix, and I go forward here and try to figure out where I'm going to pay for the stock. So if you've watched our videos before, we have our software right here. And I'm going to log in real quick. I have to hit refresh. I'm going to go to my stock tools, and I'm going to hit Netflix. And let's go actually take a look at Netflix stock and put in some assumptions about the future. First off, 8-pillar basis. So right now, there's a few issues with Netflix from the 8-pillar perspective. One, the 5-year PE is really high, 35. The 5-year price of free cash flow doesn't even exist because in the last 5 years, they haven't had free cash flow overall. If you add up all the last 5 years of free cash flow, it's been negative. Now, they've slightly increased their shares in the last 5 years. It isn't a big deal. And the same thing with their debt. I like to look at debt as a multiple of free cash flow. Well, when your average in the last 5 years is negative, you can't really look at a multiple of free cash flow. And their ROIC, the return on invested capital, is low. Does that mean you should avoid this? Again, no. If I told you could buy Netflix today for $1, would you? Absolutely you would. Even if you knew that their profit was going to fall in half every year for the next 10 years, you would still pay $1 for the company. Would you pay $1 trillion for the company? No, of course not. All right. So the value investor looks at those extremes and says, somewhere in the middle, it makes a lot of sense. The hard part is determining where that is. So I'm going to go in here and I'm going to pull up the stock analyzer tool. Now, I said this a year and a half ago about Netflix. You can watch our videos. There is a lot of competition out there for streaming now. When COVID hit, everybody got in the streaming game. Disney's killing it. Hulu's killing it. Everyone has gotten into streaming. it's become a very saturated market. At some point, there'll have to be some sort of consolidation. Now, do I think Netflix will win and be one of the ones that are left over? Yes. Will they be number one? I don't know, but they have a pretty good leg up. I love their content. Every time I go, my personal opinion is every time I go watch something on TV, I want to just scroll for streaming. Where do I go? I go to Netflix. They've got great new shows coming up all the time. This weekend, I just started watching that DB Cooper documentary. Did you watch that, Tim? Yeah. So actually, Lisa, my fiance, had never heard of DB Cooper, which blew my mind. But she never heard of him. We started watching it. And I've always been fascinated by DB Cooper. Even when I was in high school, I remember being fascinated by the whole thing. I don't know why. Maybe I am DB Cooper. Well, it's not possible because I wasn't alive in 1971. So there's a lot of great content out there. So let's go look at the next 10 years. So guys, as you can see, last 10 years, the revenue growth has been 26% per year. Clearly, that's not going to be possible going forward. They're already worried about even losing members. So just because you're losing members doesn't mean your revenue is going down. We're in a high inflationary environment. People expect to pay more. Revenue can go up. So on the low end, let's call it 1%. In the middle, 2%. High side, actually, let's call it 1%, 3%, and 5% revenue growth. Okay, so they can lose a few users, but they increase their charge, and they can figure out a way to make money off advertising. Which, by the way, don't get me started on that one. I just can't stand that. I really hope I don't have advertising on mine. Now, profit margin. Now, guys, remember, this company just recently started making money, so the profit margin here is all over the board. But look at this: the last 1 year, their growth has been nothing, but they've had huge profit margin. So I'm going to sit here and I'm going to go with 12, 15, and 18%. Now, free cash flow margin. Now, this is the hard part. Free cash flow is cash from operations less your capital expenditures. What this tells me is there are a ton of capital expenditures, probably on content. This is a concern of mine for Netflix because at some point they got to start generating free cash, because that's how you pay dividends, that's how you buy back shares, that's how you pay down debt. It's all the fundamentals of the business paid that way. Profit margin is based on net income. And net income is merely a reflection of accounting rules and all that stuff. Hang on one second. There's a notice here. Netflix announced it'll be acquiring leading animation studio Animal Logic with around 800 people, mostly in Sydney. We will fund the purchase from our existing cash balance. All right. So they're not issuing stock, which I like because the stock is cheaper now. So if they issued stock to make acquisitions, they're diluting owners. They're using the cash in their account to buy the company. Now, I don't know anything about that company. They could have a lot of great content. I have no idea, but that was just announced recently. How's the stock doing currently, Tim, if you don't mind? So free cash flow margin. The stock is currently up $15 to $217.38, almost 8%. So as you've been talking, it's gotten better and better. Now, for free cash flow, like I said, getting back to it, it is getting better and better. It is getting better and better. So let's do 4. No, let's do 6, 9, 6, 10, and 14. Over long periods of time, these should be equal. But I'm going to still assume that over the next 10 years, they're still going to spend more capital expenditures as they grow. And I'm okay with that for right now. Now, PE. I'm going to go with 13, 15, and 17. And same with with free cash flow, I'm going to go a little bit higher because it's going to be a little bit different. Now, for my desired return, I'm actually going to do 15%. Usually I do 12.5%. But in this situation, with the discrepancy between free cash flow and earnings, I want to be a little bit more conservative and give myself a little bit more margin of safety. So how do you give yourself margin of safety? Require a higher return. Because the less you pay for something, the higher your return. So that's why I do that. So what do you do here? The stock is currently at $2.18 a share. Oh, I have the after hours on our software, so I could have just looked down. It's up over 8% now. Hit the analyze button. All right. So a wide range here, guys. A low of 40 to 70, a high of 130 to 160, and in the middle, somewhere between 80 and 110. So this is a wide range. You might sit there and say, oh my God, this is so wide. Yeah, because free cash flow and profit margin are very different. So until they rebound, now you have to ask yourself, if you care more about net income and think that the free cash flow eventually take care of itself, focus on this number right here, these numbers right here. Okay? And my puts, in full disclosure, are pretty close to here. A little bit higher than that 108, but it's pretty close to there. So does that mean that's what Netflix is worth? No, that's what Netflix is worth to me. Because I can be picky. I've got 9 businesses upstairs. I've got a lot of investments going. I make a lot of money off options. I don't need to buy stocks at any price. I can buy them at the best price for me. Does that mean I might never own Netflix? Absolutely. But I'm okay with that. Your job as an investor is to be okay passing on companies. You want to make errors of omission, not errors of commission. And that means that you want to be okay. You should be okay not finding the next grand slam because you're probably going to avoid the next kerplunk, right? And Netflix was a kerplunk when it was $700 a share and went down to as low as $165 or $170. Now it's at $218.05. Sounds great and dandy. Looks great. A lot of enthusiasm, but your focus shouldn't be on the day-to-day results. Your focus should be, do I think Netflix is going to grow more in the next 10 years than people are factoring into the price today? And right now, what would it take for that to happen? Well, let's put some growth rates in here. Let's go with 4, 7, and 10. Hit the analyze button. Okay, at 4, 7, and 10, 10% revenue growth is needed based on those numbers above to hit above our price today. So 10% revenue growth is a lot, guys, especially for a company that's already struggling to get 4 or 5% revenue growth and have users stop leaving them. So just keep that in mind. If you're new to the channel and you liked what you saw, please like and subscribe to this channel. We do videos every single day, multiple videos a day. It's great content. It teaches a lot. And if it speaks to you, I love it. If you want to learn more about our 8-pillar process, click the link above on our video explaining the 8 pillars. Thank you very much for your time.